Today, we are looking at a financial instrument that is so deeply contradictory, it might honestly just give you whiplash. We're unpacking the incredibly bizarre financial paradox of Oxford Lane Capital, specifically their ticker OXLCO. Now, what if I told you there's an asset out there right now that looks like an absolute value trap on one hand, but a perfectly engineered safe haven income generator on the other? Well, in this explainer, we're going to look at the hard data, strip away all the market noise, and see exactly what Wall Street is hiding about this fascinating stock.
Now, what's really interesting about this slide is the absolute absurdity of these numbers sitting side by side. I mean, on one hand, you have a price-to-earnings ratio of 187 alongside negative earnings. That is fundamentally, mathematically impossible for any value investor to justify. But then look at the other side. You have an incredibly stable 6.2% dividend yield and a beta of just 0.10, which means it barely reacts to market panic at all. How in the world can a stock with seemingly broken financials also be an incredible pillar of dividend stability and low volatility? That's the exact puzzle we're solving today.
So, here's our roadmap. We'll start with the core paradox. Weigh the 7 glaring red flags against 7 surprising green flags, put it through the investment guru test, and wrap up with a final verdict. Section 1. The core paradox. What exactly are we dealing with here?
Okay, here's the critical catch that changes absolutely everything about how we need to evaluate this asset. OXLCO is not a common stock, it's a preferred stock. Specifically, it's the Oxford Lane Capital Corp 6.00% Series 2029 term preferred stock. Now, the parent company invests primarily in debt and equity tranches of collateralized loan obligations, or CLOs. But as a preferred stock, OXLCO sits above common equity in the capital structure but below debt. It has a fixed dividend and extremely limited upside. Because of this unique structure, you literally cannot look at it like a high-growth tech stock. You have to evaluate it much more like a bond.
Section 2. 7 glaring red flags. Let's address the bear case right up front, because the underlying business metrics are flashing some severe warning signs.
Red flag number 1. Guru Focus rates OXLCO with a GF score ranging from just 20 to 35 out of 100. For context, anything below 40 is considered extremely weak. This score signals incredibly poor future performance potential, and it actually ranks worse than 90% of asset management companies. You know, when a quality scoring system hands out a 20 out of 100, alarm bells should definitely be ringing. Red flag number 2 is a PE ratio somewhere between 187 and 241 times earnings. The industry average? Roughly 12 times. That means OXLCO trades at 15 to 20 times the industry average PE. For an asset that is structurally capped for massive growth, paying 187 times earnings is mathematically ridiculous. So the crucial point is, how do you even get a PE ratio that high? Well, you get it when your earnings are practically non-existent. Red flag number 3 is that the company is fundamentally unprofitable right now. The trailing 12 months earnings per share is negative $5.99. The most recent quarterly EPS was negative $6.17. The market is essentially assigning a massive premium multiple to completely unprofitable operations.
And it's not just the bottom line bleeding out. The top line is deteriorating rapidly too. Red flag 4. We are looking at a terrifying 41% year-over-year revenue drop. They plummeted from $355 million in revenue down to just $187 million.
Let's rapidly fire through the rest of this bear case. Red flag 5, a Piotrowski F-score of just 2, which is a major signal of poor basic operations. Red flag 6, a moat score of just 3 out of 10, meaning competitors can pretty much easily walk right over them without any structural defense. Add to that massively negative cash flows. We're talking negative $620 million in operating cash flow and negative $720 million in free cash flow. Finally, red flag 7, analyst consensus price targets are highly bearish, ranging from $6 to $13.50. That implies a 44% to 75% downside from current levels. Ouch.
Section 3. 7 surprising green flags. Time for some total tonal whiplash, because we're pivoting to the bull case. Green flag number 1 is the sheer undeniable attractiveness of the yield. OXLCO offers a 6.24% dividend yield, paying out a 13-cent quarterly fixed dividend. That's about $1.50 per share annually. In a market where treasury bonds might yield 4 to 5%, getting 6.24% is highly competitive. And remember our definition from earlier? Preferred shareholders get paid their dividends first before common stock shareholders see a single dime.
Green flag number 2 is its beta, an incredibly low 0.10. And this brilliantly illustrates how the stock is 90% less volatile than the broader market. For an income-focused investor who really prioritizes preserving their capital, this acts as an amazing portfolio diversifier. When the rest of the stock market is swinging wildly, this asset basically just sits there completely unbothered.
Green flag number 3 might honestly be the most reassuring data point we've looked at so far. Despite all those ugly red flags regarding revenue and cash flow, the probability of financial distress is just 0.05%. This metric measures the likelihood of bankruptcy over the next 12 months. It is virtually zero. As a preferred stock investor, all you really need is for the company to just survive so you can keep collecting your fixed payments. And this metric says you're very safe for now.
Green flag number 4 is a shocking bullish signal: insider sentiment. Insiders have recently accumulated 15.2 million shares, resulting in a net buying of positive $80.1 million. When the people inside the actual company are aggressively putting their own hard-earned money to work, it's a massive signal of confidence that the mainstream media is completely ignoring.
Let's summarize the rest of the green flags. Green flag 5, an incredibly tight 52-week trading range of just $22.95 to $24.98. That is true capital stability right there. Green flag 6, a surprisingly strong balance sheet. They have $295 million in cash and $2.84 billion in assets, against just $883 million in liabilities, leaving them with a very low debt-to-equity ratio of 0.25. This balance sheet provides a massive cushion against their struggling day-to-day operations. And finally, green flag 7, strong bullish technicals. It scores a 94 out of 100 on technical quality score, trading well above its major moving averages.
7 red, 7 green. Section 4, the investment guru test. Let's test this heavily conflicted asset against the frameworks of history's greatest investing minds.
Let's stack them up. First, Benjamin Graham. Verdict: fail. The father of value investing would reject this immediately. The 187 XPE is absurdly high. Earnings are negative, and the current ratio is way too low. Next, Peter Lynch. Verdict: fail. Lynch demands a PEG ratio below 1.0, which measures growth against price. But with negative earnings, you can't even calculate that metric. Finally, Warren Buffett. Verdict: fail. Buffett demands durable competitive advantages and positive free cash flow. OXLCO has zero moat and is burning through $720 million in negative free cash flow. So yeah, it completely fails all traditional value and growth metrics.
Section 5, the final verdict. If the greatest investors in history would run from this, who is actually buying it? Okay, let's dive into this. If you are a value or growth investor following the footsteps of Graham, Lynch, or Buffett, this is a hard pass. The financials are absolute non-negotiable deal breakers. But if you're an income investor, this is a dedicated yield play. Because of its preferred status, incredibly low volatility, and that fixed 6.24% dividend, OXLCO must be viewed strictly as a bond alternative, not a common equity value play. The underlying business quality is definitely poor, but that massive balance sheet cushion keeps the yield totally safe for now. So if you're a conservative investor looking to safely utilize this unique portfolio diversifier, here is your highly specific action plan based on the data we've covered. Step 1, always evaluate it as a preferred stock with limited upside, not a growth engine. Step 2, compare its 6.24% yield directly to 4 to 5% treasury yields or investment-grade corporate bonds to make absolutely sure you're getting enough premium for the risk. Step 3, size your position appropriately. Keep this as a small allocation, definitely not a core portfolio holding. And step 4, constantly monitor the parent common stock OXLC, because if the parent company starts to truly collapse, your preferred dividends will eventually be on the chopping block. Which brings us to the ultimate question for your own portfolio. The scale of justice is literally in your hands. After seeing all this data, are you buying in for that incredibly stable 6.24% yield, or are you staying far away to avoid those 7 glaring red flags? It is a fascinating paradox, and I hope this explainer gave you the structured clarity you need to decide. Thanks so much for learning with me today, and keep questioning the numbers.